Okay, so now we're going to pivot to one of our favorite topics, generally speaking, crypto, blockchain, distributed ledger, its place in financial services, its adoption, its evolution. I think interesting timing today because I believe the Senate is marking up the House version of the Clarity Act. As we're
Correct.
doing this video right now.
Exactly.
So there'll be, which I think ultimately is them agreeing or disagreeing, adding amendments, editing, and deciding whether or not they're going to move forward with a vote on this particular piece of legislation. So this is on the, well, a few months back, I would have said on the heels of the Genius Act, but it's been delayed.
Uh-huh.
One of the biggest issues or points of contention with this bill was actually a key component of the Genius Act, which was the yield piece on
Yep.
stablecoin. And I wanted to get your take on just high level this piece of legislation, which is the markets piece, defining what these assets are and what regulatory bodies have what roles and oversight over them. But as well, it seems like the big sticking point here and the delay largely attributable to the yield issue coming out of the Genius Act, where private issuer of stablecoins are not allowed to pay holders of stablecoin yield on that, which is largely supported by the banking community and the banking lobby.
Right.
And from what I can tell, there's been quite a few headlines in the last couple of weeks about a compromise having been reached on that, trying to address that in the Clarity Act, and the compromise is really will remain in place for people who passively hold stablecoin, but for people upon usage, like if they're using it for payments or they're using it, or they're lending it, I should say, they would be able to accrue rewards. We're not saying yield, but we're saying rewards in that active usage of stablecoin as opposed to just the passive. So I wanted to get your thoughts on, well, first of all, it'd be interesting to get a prediction whether this thing goes through today. Excuse me for a second. Number one. Number two, do you think that they actually did compromise and change anything? Because to me, it kind of looks like a sop that they gave to the crypto community. I don't think the banks actually yielded much ground in the Clarity Act. But I'd love to hear if you agree, disagree.
High level Genius Act, that was for stable coins specific. And the regulation requirements around that were going to be more bank like. There's going to be certain requirements of fully backed stable coins. So a dollar stable coin had to have a dollar in reserves that backed it. There are AML and KYC rules that were very similar to the banks. As a matter of fact, it's the regulatory bodies there, which is one of your topics, would have oversight of that. And non-bank issuers of stablecoins could become issuers of stablecoin if they abided by those regulations. And so that was kind of unique at the time, and it gave the beginning of some regulatory structure that was badly needed around stablecoins in the U.S. The Clarity Act is ongoing here, but it's really about the key takeaway for me is that yield question, and it acts. Sorry, no pun intended, but it performs similar to a payment card transaction that we were just talking about, so that I could get rewards on any transaction. Now, there is actually movement in a medium of exchange there, and I think the dust up with the banks was, what about people buying stable coins and it sits in their wallet, in their electronic wallet? Are they able to earn yield? And if they are, what does that mean? Where do the banks stand in all this? Like, why? What would happen to us in that environment? And that's a legitimate question. And it like you said, it sounds like at this juncture that there wouldn't be any stagnant yield. There had to be movement in order for yield to be relevant, which means it's transitory to me with a purpose. So it's kind of a short term yield, which is another word for rewards, the way I read it. Now we'll see how they hash that out. I was a little surprised that some of these details were not more agreed upon behind the scenes. So in Washington, D.C., in these bills, as I'm sure you know, and some of the viewers may know, there are very few legislative accidents. Almost everything is hashed out in advance. So like there isn't like this dramatic moment on the floor where there's new evidence or new idea and everything goes to hell in a handbasket. I know it happens, but generally speaking, this is something that they've worked on a long time. So we're in a different world with stablecoins, and it's not just the stablecoin, but what it represents. It's new. It's not widely used in the U.S. The economics are different, which is another way of saying it's lower. The economics are lower for the participants in the traditional ecosystem. The economics could be lower, not necessarily, but could be lower than what banks are getting. And so there's a threat to the existing structure of business. And it's not surprising that the financial institutions are, resisting on the yield side. If I was a bank, it would be something that I would be considering as well. Like, I might oppose it as well, to be totally honest.
But am I being overly cynical when I look at this? And first of all, the Clarity Act seems to have evolved into a mopping up of unresolved issues of the Genius Act.
100%.
More than standing on its own, which was to create market structure so that the digital asset community innovators can actually innovate and do things, and they know where they stand. They know the rules of the road, the regulatory regime, who's governing, who has oversight. But it's actually morphed into this cleaning up of the yield mess, the yield confusion, the yield challenges from both sides coming out of the Genius Act. And again, I don't know the compromise, so it's been reported. I don't know how much of a compromise it was. I think that's what they had before, the ability to do that. I think that's what they're winding up with. So what did the digital asset community or our ecosystem participants, what are they actually gaining at this point that they didn't have before?
Well, I think that you've in print regulations and for who governs what and what some of the basic operating rules are, right? So you have SEC on this is Clarity Act, right. On the tokenization, right? And then excuse me, you have SEC on the tokenization of securities. You have CFTC, right, on the DeFi side. So that's how they kind of separated it, and so SEC tends to be more centralized stuff, and on the Clarity Act, the DeFi is CFTC. So two different entities there, and then you have on the stablecoin side, the traditional in place regulatory bodies that oversee financial institutions. So there's something there that's in print, which is what everyone wanted, because not too long ago, the SEC and perhaps some other regulatory bodies would regulate by enforcement. And it was just a surprise, and there'd be a lawsuit from the government hand it off to a company just out of the blue, and they
This
would
is
have to go defend themselves.
the Gensler SEC, the Gary
Yeah, that's
Gensler
correct.
SEC.
And
Right.
they'd have to defend themselves, and not all, but some of those were tossed out as arbitrary, and it created a very uncertain environment and restricted development and new business creation in the U.S. for DeFi and anything around it, anything related to it, including some of the digital asset classes. There's a reason why business to business transactions overseas in the trillions of dollars, and has been for a number of years, and many people in the U.S. that weren't even aware of that. So they've wrestled with these things in some of these other countries and figured some parts of it out. We needed a complete soup to nuts, and this is a good start. We'll see what happens today, right? We don't know the outcome. I don't know the outcome, but I am hopeful that it's generally in line with what we're talking about, even if, to your point, more isn't given up per se. That we get something that is in writing that people can say, okay, my counsel, what does this mean? And have that translate into a business plan. Whereas before, and I had some brushes with this, it was ambiguous, depending on who you were speaking with in the government.
I think there's another piece to this that has been underreported, and ultimately may be the sticking point. I have been paying attention to the yield issue and kind of how that's going to be addressed or redressed in the Clarity Act. I think there's, I look at what the Democrats on the banking committee have been focused on a lot has been the AML piece of digital assets. And to that extent, I don't know that there, has been a lot of, it's unclear to me that there's been a lot of, forgive the expression, clarity around how alternative digital assets are going to be managed, overseen by whom, and how AML protections or oversight will be enforced, and by whom. And that to me might be the sneaky little element of this that hangs it up still from going to vote on the Senate floor.
So, excellent point. My response is AML and KYC are doable. So anti-money laundering and know your customer respectively are doable because somewhere the consumers have to have a financial institution that's funding these stable coins or tokens or whatever digital assets. So it's coming from somewhere, and that somewhere has to have it. And I know that there's supposed to be another layer here, but that is, that's the argument of the crypto, is that, hey, you guys have already vetted this. Now we got to do it all over again.
Do you find that to be credible? Because to me, that's that doesn't play for me entirely, because certainly the AML is done at the bank, but
Right.
once that money is moved into a digital wallet and is converted into a digital asset, okay, where's the AML there?
So,
And then
well,
moved.
I think that's the sticking point.
Right. Okay.
And so it's a double dip on ID, intent, purpose, and if it works, if the cryptocurrencies work, if the digital assets work as advertised, there's going to be information associated with that on either side, and it's how much, and they're hashing that out. So if you think about it, what the vagueness, the opaqueness of quote cryptocurrency or digital assets is that there's this belief of pseudo anonymity in purchasing goods and services in the world, and that's true as long as someone doesn't look, right? As long as someone doesn't request the records, but it's true for that purchase. Okay, so there's a timing thing there, and I think so. I think there's some education that needs to take place with some that, hey, look, a lot of this information actually is available, but someone has to request it to find out. Now, that doesn't make anyone feel more comfortable in the wild, wild west of e-commerce, particularly overseas, if all of these safeguards aren't linked to the same level that you would have at a bank, right? I think that's the issue. And so that's, as you pointed out, it's unresolved, and I don't know how they're going to hash that out.
So, if you were to make a prediction, you would lean toward perhaps it's going to take a little bit longer?
Yeah, my answer would be yes. Yes.
Okay. Okay.
Yes.
I feel that way. I think it's also because I think the reality, the political reality is they need to flip, or they need to proselytize 7 Democrats, I think, to get it through. The Senate does. I don't know if they have them. I think there's been some, at least politically, the Democrats have been, I don't want to say falling in line, but they have been, they do seem to be leaning towards my home senator's, a lot of her objections, Elizabeth Warren's objections, that it is still very much will be still very much the Wild West as it relates to the anti money laundering oversight and regulation and structure, as well as the KYC and the KYB. It hasn't been defined sufficiently to date, and that needs to be really that has to be very explicit, I think, in the legislation for it to go through.
So do you think that there's too much on the table here? There's too many. This is for the Clarity Act that's in front of was the Senate Banking Committee right now. That they got too much to consider. That they need to do this in pieces.
I mean, they should all have known what is being contemplated here. I think that again,
they don't have answers to them all, right? That's what we're talking
again,
about,
I go
right?
back to that expression, mopping up the what seems to be an unresolved issue coming out of the Genius Act, even though it is resolved. I mean, it was made into legislation, but the yield issue has been the bright shiny object that everybody's looking at. I think it's that AML piece that's more important in the Clarity Act. And ultimately that probably, I mean, I can't see it passing without really clear, explicit definition along those, the AML and the KYC, KYB lines. But that's just my opinion.
I think that we're in agreement here. We're getting to the same place in terms of finality and duration of this argument in Congress, that it won't be resolved right away. So I agree that the yield to me was, so being commerce business oriented, I was naturally drawn to the yield discussion 100%. And if the trade-off is that it's transactional and not stationary, then at least I get that. AML and KYC is not going away, and we see it all the time. There are issues all the time from institutions that you would think have this stuff, right? You would think it would be difficult for these things to happen, yet they do. And So I think it's an excellent point.
In the real economy, in the real world, where commerce is conducted, B2B or B2C, those pieces are extremely important. Corporations need to be responsible for them. Um, and so they need to understand exactly what their responsibilities will be if they accept or use this type of this medium of exchange, the store of value, um, uh, which isn't fiat for transactional purposes.
Right.
And so I think it's a very good point, and it'll be interesting to see what happens later on today or as we're speaking right now.